Hi, morning everyone. Welcome to our session this morning. I'm just going to give about 3 minutes again, just if there is someone that still wants to join. So yeah, let's make it 4 minutes. Okay, another 4 minutes. So let's start at 25 to 9. So if you quickly want to grab a cup of coffee or something, you're welcome to do so. We are going to do the 2024 paper today. So if you want to get that from the library, you're also welcome to do that. I will show it on my screen, but just in case. So on Tuesday, we did the 2025 paper. So then today, the 2024 paper. Okay, so at about 25 to 9, then we'll properly start. Yeah, I think we can then properly start. I think this is it for today. Okay, so for those of you that missed it maybe earlier on, So on Tuesday, we did the 2025 paper. So the recording is uploaded on the YouTube channel. So if you missed that, just please go and have a look there. And then today we're going to do the 2024 paper. Okay, so you'll see in the slides what I did is, oh, sorry for that. You're going to hear that a lot today. Okay, so sorry. If it's really bad, then I'll mute myself. So in the 2024 paper, you'll also see the 2025 one, the slides. What I did is before I did the question, I just quickly did some theory recap on that specific learning unit. So I did focus on that on Tuesday. So for today, I'm not going to do the focus on that as much, but it is in the slides. Okay, so you will see that. But just so that you know, the focus on will not be on that too much today, because on Tuesday we properly did that. Okay, so I'm going to share my screen so that you can see what I see. Okay, so, oh, sorry. So you'll see I have the paper. So I'm going to look at the paper as if you are the one now sort of reading through this. And then we go and see what learning unit is this. And then we're going to do the question. Okay, so let's see if that's going to work. Okay, so question 1, and it's not necessarily that it will give you the information within the question. It might be that you need to go and look at the required part to just see in what learning unit we are. Okay, but this question 1, they tell you that TechMart Limited is a publicly traded technology retailer listed on the JSE. The company's chief financial officer recently reached out to the accounting firm where you work as a consultant, requesting assistance with the measurement and disclosure of several assets in accordance with, and then they tell you, IFRS 13 fair value measurement. Okay, and then if you look at the required part, they ask you to calculate the fair values of each of the above assets and liabilities in accordance with the requirements of IFRS 13 fair value measurement. Okay, so now we know where we are. We are in learning unit 4, the fair value measurement. Okay, so you'll see then now on the slides. Let's do that. So what I did is I just quickly did a recap on fair value measurement. Okay, so just so that you can remember that. So the definition is always important, especially if they ask you a theory type of question, or if they ask you to calculate the fair value and explain why, or describe why, or something like that. It's always a good idea to come back to the definition of a fair value. Okay, so as I mentioned, I'm not going to read through everything again today. So please look at the recording for Tuesday. We did that there properly, everything. Okay, and then the price. Remember, that is also an important part because it's not adjusted for transaction costs. And that's very important to remember, that your fair value, the amount of your fair value, does not include transaction cost. Okay, so if they tell you it does, let's say they tell you the fair value is R1,000,000 after transaction cost of 100,000 Rand, for instance, then you have to take out the transaction cost, okay, because it should not be included in the fair value amount. And then in transport cost can be included, okay, depending on if the location is a factor in the price. Okay, then the application is also just important. Then a non-financial asset will always be based on the highest and best use. It should be physically possible, legally permissible, financially feasible. Okay, and then we get the 3 techniques: market approach, cost approach, income approach. Okay, so that's also important to know. And then the hierarchy, sorry. This is also important. You'll see if you look at the 2025, 2024, 2023 paper. In all of them, this was asked. So they ask you to calculate the fair value and state what level it is in. Okay, so make sure you know the levels. Okay, and also to give a bit of an explanation or a description, because they also like to ask you that. Give the level and say the reason why you give that level, okay, whatever. So make sure that you also can explain it a little bit as to why you choose these levels. Okay, so now we can get to the actual question. Okay, so we had a look at the first paragraph. So then in the second one, they tell us that TechMod has a financial year ending of 30 June 2024. The following details regarding assets and liabilities measured at fair value for the current year have been provided. Okay, I'm going to do them one by one. So remember, the first question was to calculate the fair value of each of these assets and liabilities on 30 June 2024 in accordance with the requirements of IFRS 13. And then for each calculation, include an explanation of the type of asset or liability and explain the valuation approach used. Okay, make sure that you see that. Don't just calculate. If you need to include an explanation, make sure that you include an explanation. Okay, make very sure about that. Because sometimes in the memo, it tells the marker that if there's no explanation, no marks can be awarded. Okay, so then you're going to lose everything. So please make very sure about that. Even though your explanation can be wrong, that's okay. You just need an explanation. Okay, so let's quickly look at the first one. So the first one is investment properties. And there they tell us that TechMod holds an office building that is leased out to third parties and carried under the fair value model in AIS 40. In its current use, the present value of the net future cash flow was calculated at 7,520,000 on 30 June 2024. Then they tell us on 30 June 2024, this office building could be sold in the open market for 8.2 million before transaction cost of 5%. The open market value was determined with reference to a limited number of similar buildings situated in the same location that are currently in the market. Okay, so remember their highest and best use. Okay, and also remember for the highest and best use, it doesn't matter if they tell you the company is not going to do that. Okay, we don't care whether they're going to do it or not. We need the highest and best use. Okay, so let's quickly look at that one. Okay, so there you can see investment properties. The explanation, this is a non-financial asset and it should be valued at the highest and best use. Okay, remember I asked you the valuation technique that you're going to use. Then you give the facts. The value in accordance with the current use, 7,520,000. In the open market, if that asset is sold, it's 8.2 million. And now we need to choose the highest and best use. And that highest and best use value is then 8.2 million. Okay, again, remember, irrelevant of whether the company will sell or not. Okay, sometimes they will tell you something like, this investment was inherited, so they do not want to sell. Okay, we don't care. Highest and best use. Okay, irrelevant of whether the company is going to do that or not. Okay, so if I move too quick, please, you're welcome to just interrupt me and stop me. Okay, then the next
Morning,
one
ma'am.
is a listed investment. Okay, and I want to say, in a sense, these things are things that you can study in a sense, meaning if it's a listed investment, it's probably the way it's going to look. If it's unlisted, this is what you will use. If it's investment property, that's what you will use. Okay, so there's sort of a norm in all of these. Okay, so under listed investments, they tell us on 30 June, TechMod's listed investments consisting of equity investments had a total net market value of 4,455,000 after a brokerage fee of 1% were deducted. Okay, so there you can see, because they tell you it's after the fee, that fee is included in the 4.4 million. We need to exclude that fee. Then they tell us these investments are traded in an active market. The fair value of these investments was 4.2 million, but now be careful. That was on 30 June 2023. Okay, so that's the previous year. So please don't use that figure. Even though they tell you that's the fair value, you sort of want to use that, but be careful of the date. Okay, so that's the catch in this question. And then they tell us these investments were classified as measured at fair value through profit or loss. Okay, so we need to use this market value, but before the brokerage fee. Okay, so if they include the brokerage fee, and that brokerage fee is 1%, meaning this value is 99% of the original value. So you can, if you divide that by 99%, you will get the value before the brokerage fee. Okay, let's quickly look at that one. Okay, so it's there at the bottom of the slide. Listed investment. This is a financial asset that should be valued using the market approach. So they give you the market value. So it's the market approach. And that market value before the brokerage fee is 4,455,000 divided by 99%. So then your fair value is 4.5 million. Okay, then the next one we have is an unlisted investment. So there they tell us that TechMod obtained a 15% interest in Nexus Limited on the 2nd of August 2022 for 3.8 million. The fair value and carrying amount of the investment were 4,050,000. Again, be careful of the date, on 30 June 2023. And then they tell us, on 30 June 2024, the accountant of TechMod calculated the fair value of the investment in Nexus Limited by using a significantly adjusted after-tax earning yield of 20% and sustainable before-tax earnings of 1,260,274 as input variables in the measurement calculation. And then they tell us the tax rate is 27%, and this investment was classified as measured at fair value through other comprehensive income. Okay, very important. The earnings yield they give us is after tax, but the tax or the earnings they give us is before tax. So we need both of them to be after tax. So you will take the earnings, calculate tax on that and deduct that. And then that is divided by the 20%. Okay, so let's quickly look at that one. So your unlisted investment. This is a financial asset that should be valued by using the income approach.
Hello?
So if you take the amount and you times that with 73%, that is the after-tax amount. Okay, or you can take the amount, times that by 27%, and then just deduct that from the original amount. Okay, because if you times by 27, you get the tax value.
Hello?
Sorry, I think my volume is very low. Yes.
Do you mind if I just ask you a quick question?
Yeah, no, you can go.
Okay, so can you just go over the investment property slide, if you mind going back to that so I can just ask, because it was with regards to that question. Yeah.
This one,
So
yes.
I understand that you need to use the highest and best value use. and which is 8.2 million. But then what's the 4.5 million? Like, do we need to then show that?
So that's the next one. That's the listed investment.
All right. And then also in these questions, do we need to then, is this just purely the working, and then for the part two, we will say if it's a level 1, 2, or 3, and what techniques we've used.
So you'll see the technique is in there already. So like for the first one, investment property is valued at the highest and best use. So that is enough for the technique that you've used. Same for the listed investment. It's a financial asset and we use the market approach.
Okay. Okay. I see. Okay. Fine. Thank you so much.
Yeah. Okay. Yeah. So we're still going to get to 1.2, where they ask you to do the measurement disclosure note. So we'll still do that one.
So in the exam, like, it's very likely that it's going to be scenarios like this where they give us transactions and we're going to have to adjust the fair value and then say what it is, correct?
Yes, because it's been like that now for about 3-4 years that they ask it exactly like this.
All right. I appreciate your assistance. Thank you.
Okay.
Good morning, Mrs. Rothman.
Yes, morning.
How are you?
I'm good, thanks. And you?
I'm good. I wanted to find out, will you be able to share with us these slides if you haven't already done it, or?
What I will do, I share it with the lecturers and then they can actually share it with you guys. But what I will do, I'll type my email there. And then you can also send me an email and then I can just send the slides to you.
Thank you. Thank you. I'll do that.
Yeah, and what you can then just in the email, you can also ask me for the 2025 ones that we did on Tuesday, because there was only 2 students in the teams. So obviously, I think none of you actually were there on Tuesday. So you're welcome to just ask me. You can just ask me the slides for the masterclass, and then I'll also share the 2025 and the 2024 ones.
Thank you so much.
Okay.
Thank you, man. We appreciate it.
It's a pleasure. Yeah, so I think maybe if you are, I know some of you like have your class rep or whatever. So if you want to, and then just send me one email and I can reply and they can distribute it, that's fine. Or if you all want to send me an email, that's also fine. It might just take then a moment to actually get it to you. But yeah, I will be on my emails over the weekend as well, because I know you are writing on Wednesday. So obviously you're going to study this weekend. Okay, so let's quickly get back. Okay, so the unlisted investment, we then need to get the after-tax earnings, and then we can use the after-tax earnings yield to get the fair value. Okay, then the next one is a foreign exchange contract. So there they tell us on the 1st of May 2024, TechMart entered into a foreign exchange contract to buy $620,000 at 18.20 Rand on the 31st of July 2024 in order to settle an existing foreign creditor. On 30 June 2024, the spot exchange rate was 18.40 Rand for $1, and the foreign exchange contract expiring on the 31st of July 2024 was quoted at 18.60 Rand. Okay, so we've got a rate on the 30th of June, but they also tell us exactly what the amount is for the contract that expires on the 31st of July 2024. Okay, so there you will see we use the 18.60 Rand, okay, because it's specifically for that contract. So, sorry, I just want to jump back to the question. So on 30 June, the rate for these contracts is 18.60 Rand. Okay, so it's not the value on 31 July, it's the value on 30 June, but for this specific contract. Okay, so even though they give us the spot exchange rate, the spot exchange rate is sort of the normal rate that we're going to use for everything. But then they tell us these specific contracts that we are busy with is 18.60 Rand. Okay, but then remember, at the beginning when we entered into the contract, it was 18.20 Rand. So we just look at the difference between the two. Okay, so this is a financial asset, should be valued by using the market approach. Oh, sorry about that.
Ma'am, do you think this section is going to also be worth in our exam, like 40 to 60 marks, like it has been in the past?
Probably, because remember, they haven't really tested you on Learning Unit 4 and then also Learning Unit 5. So the focus for the exam is then normally more Learning Unit 4 and 5 because there was no test on those learning units. Okay, then the last one is debentures. So on the 1st of July 2022, they issued 200,000 8% debentures of 12 Rand each in the open market for 2,250,000. They were redeemable at par on 30 June 2027. Interest is payable annually in arrears. The market in which these debentures are traded became inactive, and one cannot rely on the quoted prices or on the market price of similar instruments. On 30 June 2024, the risk-free rate was 8%. The risk premium for non-performance was estimated to be 3%. Okay, so now we need to calculate the present value. So your future value is 2.4 million. Then for the interest, you have to add the risk rate as well. Okay, so it's the 8% plus the 3%. And then the years is only what is left. Okay, so I'm just quickly going to go back. So they tell you they issued it in 2022. It's redeemable at par on 30 June 2027. Okay, so we are 30 June 2024. That's where we are. So 2025, 2026, 2027. Okay, so if we calculate fair value, it's only the years that we have left. It's not everything. It's not the total years. It's only what we have left. So that's where the 3 is coming in. And then your payment. So it's 8% debentures. So it's your future value times 8% will give you the payment. And then you get your present value. And then your explanation. This is a financial liability that should be valued by using the income approach. This liability will be carried as an asset by a third party and should be valued from the perspective of the market participants that hold these debentures as assets.
So you said even if we don't, like, I know the definition, we just need to write something so we can, like, potentially get some marks.
Yes, yes. Yeah. Yeah, even if it's completely wrong, that's fine. You just need at least something explaining yourself. Okay, then we can look at 1.2. And you'll see 1.2 is again quite a lot of marks. So they ask you to provide the fair value measurement disclosure note to the annual financial statement as at 30 June 2024. Okay, so let's look at that. So this is now where the levels is coming in. Okay, so you can see I copied the memo actually there so that you can see where marks are allocated as well. So the assets and liabilities are categorized in terms of their fair value as follows. So there you can see the non-financial assets is investment property. Then in the first column, you give the fair value. Then it's the level. So whichever level you think it is, that's where the amount is gonna go again. And then what is the technique and input? Okay, so in this case, it was an inactive market price. So this is why this is a level 2.
But isn't it because we have a market price available? It should be level 1.
No, because that was your highest and best use. So highest and best use is always level 2. Okay, then the financial assets, your equity instrument, the listed one, that is level 1 because that's an active market price. Then the unlisted one, for unlisted, this will normally be level 3. The reason for that is we don't have actually any information. We don't have a market price. We don't have a similar instrument that we compare that to. So if we use any earnings, yields, and adjusted earnings, then we know this is a level 3 because it's basically what we have in our company and we use that as the fair value. Then your foreign exchange contract, that's also level 1 because they gave us the exact exchange rates and we know, okay, this is what it is. It's market related. So we have a quoted foreign exchange contract. Then we move to the financial liabilities. Debentures measured at fair value through profit or loss. That was a level 3 because again, we don't really have anything in the market. We use the risk adjusted rates. And then lastly, on that foreign exchange contract, we have a creditor that we still need to repay. And for that, we use the spot rate. So that's the 18 Rand 40. And that is then also a quoted spot rate. So it's level 1 because that is what the market tells us the value is. Okay, sorry. Okay, any questions on question 1? Oh, sorry, I missed this one. For the unlisted investment, as we only obtained a 15% interest, would we not times the fair value by 15% like they did in 2025? Let's quickly look at that one. Unlisted 15% interest. I'm quickly going to open the 2025 one as well. I can now remember how we did that one. Oh no, the 15 we used was the after-tax earnings yield. Okay, so just be careful on that one. So on, I'm gonna do that. So in 2025, they tell us they acquired 15% interest, and then they give you the fair value, the after adjust earnings yield of 15%. So that's the 15 that we've used. Okay, so if I can quickly go to that transaction, the 15 that we used there is the after-tax earnings yield. Okay, that's actually a good question because it's something that you're probably going to wonder. Okay, so just take note of that one. Okay, so thanks for that question. Otherwise, you sit in the exam and then you wonder about that. Okay, see if there's any other questions that I missed. Okay, Darren, I think I did explain that one, why I said it's level 1.
Ma'am, do you think for IAS 5 they're going to ask discontinued operations, or will it be disposal of group assets, or like something else?
I must say I'm a little bit scared that they will ask the discontinued operations, because I think it's now 2 years that they didn't ask that. But in the 2023 paper, they did. So yeah, personally, I'm wondering if that's not the one that's going to come up.
Yeah, it's just so difficult. It's like impossible.
Yeah, that is yeah. I don't know if you guys did any questions on that in class. Or did you only focus on the textbook?
Can we do a discontinued operations question together on that?
I think we should be able to. If we have time, we can do that. That's fine. Sorry, I'm just quickly looking at this one. They times by 15% for the fair value adjustment, though. Fair value adjustment. For this one. Okay, if you're referring to this adjustment, they still didn't. The 2 million is given. The 3.65 million is what we calculated the amount to be. So the difference is the 1.65 million. And then there they just gave the level at 2.3. Okay, but the 3.6, let me just get there. There we calculated the 3.6 million. Okay, so it's not necessarily going to be 15% of that amount, because they told us the thing about the insurance. There was insurance, and then they scrapped the vehicles. And then on that 5 million, we calculated the after tax. So this is the earnings after tax. Okay, so not necessarily 15% of that amount. I think that was my just... Well, yeah, it will be 15%, because there we said 3.65 million divided by the after-tax earnings yield, which is the 15%. Okay, so it doesn't have anything to do with the 15% shares that they bought. Yeah, I think we sorted that one out. Okay, any other questions before we continue with question 2? Okay, so let's go to question 2. Okay, so in question 2, they tell us Tiny Treasure CC is an online retailer that specializes in selling interactive educational toys. Okay, by just reading that, you can't really see where we are. So if we go down to the required part, they ask you to state with reasons the total amount of revenue that they will recognize regarding the contract. Okay, so revenue recognition, you need to think this is learning unit 2. They also ask you to prepare the journal entries. This is to recognize the sale of the toys, and then the journal entries that should be processed on the 31st of December in respect of the toys sold during October. And then discuss with reasons how the transaction price will be determined. Okay, so transaction price, and then there they tell you it should be in accordance with IFRS 15, revenue from contracts with customers. Okay, so now we know we are in learning unit 2. Okay, so back to the slides. Now I must just find myself again. There we go. Okay, so learning unit 2 is then revenue from contracts with customers. So again, just a bit of refreshing the memory. There's a definition of revenue. And because it's income arising in the ordinary course of activities, we also have the definition of income. Then remember your 5 steps. And then for learning unit 2, they can, in this question, they ask you the journals. So they can ask you journals and calculations. Or what they can do is make this a very theoretical question where they can ask you by using the 5-step model, say whether this is revenue from contracts with customers. Then you literally have to say, this is step 1, name the step, explain the step, and then you do step 2, 3, 4, and 5. Okay, so this can be, it has been in the past that they ask this as a very theoretical question. Okay, so just be careful of that. It's not necessarily only going to be journals and calculations. Okay, so just be careful of that. And then I've just did a bit of an explanation on the steps. Sorry. And then contract cost is 2 categories. The incremental cost of obtaining the contract, and then also the cost to fulfill the contract. Okay, so that's 2 different things. Okay, then we can look at question 2. Okay, so we said that this company specializes in selling interactive educational toys. They have a 31 December year end. The company offers a 60-day return policy for all its toys. Sorry. And then customers can purchase toys on credit with a 60-day payment term. The following informative relates to the current financial year. Sorry, information. Then they tell us fun zone. So Tiny Treasures sold a batch of kits on 3 January with a cash selling price of 220,000 Rand. However, apologies, just give me a minute. Okay, sorry, let's see if this is going to be better. Okay, so they sold a batch of kits, cash selling price, and then the customer agreed to purchase the kits for 280,000 Rand, payable on 31 December 2024. And then there's no return policy. And then for October, they sold 4,000 units on credit. By the 31st of December 2023, 65% of the expected returns from the toys sold in October had been processed. Based on the historical data, they expect a 30% return rate on all toys sold. Each toy has a manufacturing cost of 320 Rand to the company, and it's sold at a markup of 100% on cost. Okay, and then they tell us Kids World Stores. Tiny Treasures entered into a contract with its customer, Kids World Stores, a national chain of toy retail stores. According to the contract, Tiny Treasure CC will sell 1,000 units of its newly developed learning tablets for kids called KitPad to Kids World Stores at 8,500 Rand per unit. This contract falls under the scope of IFRS 15. Control of the KitPad is transferred to the customer upon purchase. And then as part of the agreement, they agreed to provide price protection to Kids World Stores by reimbursing them for the difference between the 8,500 Rand price and the lowest price that Tiny Treasure will offer these KitPads to other retailers within the next 6 months. And then based on experience with similar arrangement, they estimated the following probability for potential price reduction over the next 6 months. No price reduction is 60%. A price reduction of 500 Rand is 30%. And a price reduction of 1,000 Rand is a 10% probability. And then Tiny Treasure has a large number of contracts with customers that have similar characteristics. And then they ask you, 2.1, state with reasons the total amount of revenue that Tiny Treasure will recognize regarding the contract with Fun Zone Pty Limited. Okay, so if we go back to Fun Zone, this is where they sold them this batch of kits. Very important, they give you the cash selling price, but they tell you this is a customer, they purchased this and it's payable on 31 December 2024. So if they ask you to do journals, remember this is not going to go to bank, okay, because they didn't pay us yet. Okay. And also the important thing is they tell us the sales for October, they sold 4,000 units. But of that, they expect a 30% return. So then if we recognize revenue, it's only going to be on 70% that we recognize revenue. Okay, the other 30% we think will be returned. So we can't recognize that revenue yet. We can only recognize that revenue after the 60 days have lapsed, and they cannot return that anymore. Okay, but they first ask you to explain. So you can have something like the time lapse between the inception of the contract and the date that the customer makes payment is indicative that the contract contains a significant financing component. You will also see they purchase it at quite a high price. Hence, the promised consideration has been adjusted for the effects of time value of money. Okay, apologies again. Okay, and then the total amount of 220,000 will be recognized as revenue in the financial statements of Tiny Treasure. The difference between the cash selling price and the contract price will be recognized as finance income over the period of the contract. Okay.
How did you get to the 220,000?
That's the cash price they gave you. So I can jump back. So there they tell you the cash selling price is 220, but they purchased this for 280 because they only pay it sometime later.
But are we not only supposed to recognize 70% of the sales because 30% is going to be returned?
That we're going to do in the journals.
Oh, fine. Thank you.
Yeah. So they sort of just ask I want to say the general thing. So on the general thing, that is what you will do. When we get to the journals and we look at specifically the month of October, that's only where the 30% is then going to come in. Okay, let's look at 2.2, and I think then thereafter we can quickly take a break and then we'll continue. So at 2.2, they ask you to do the journal entries that Tiny Treasure should process to recognize the sale of the toys during October. In other words, at the point of sale, journal narrations is not required. Okay, on that journal narrations, please make very sure that if it is required, that you will remember that. Okay, that's easy marks. So just make sure that when you read what they ask you, that you make sure whether it's required or not. Okay, obviously, if it's not required, then please don't fill it in because it's going to waste your time. But if they require that, that's easy marks. Okay, so this is now what I spoke about earlier on, where the 30% return rate is coming in. So we can recognize revenue of 70% because they expect a 30% return rate. Okay, so let's quickly look at that. Okay, remember also it's trade receivables because they, sorry, they will only pay it after 60 days. Okay, and then they tell us there's 100% markup. So that's why you can use the cost and sum it times 2. And then the units is 4,000 units. Then of that amount, 70% is the revenue that we will recognize. And then 30% is a refund liability. Okay, because remember, if they return the product, we need to give them back their money, or then in this case, deduct it from their invoice, and then they're going to pay us less. Okay, so that's a liability for us. And then don't forget the cost of sales part. Okay, I don't know if you can still remember in first year, but in first year we did, if you sell something, it's either bank or debtors control and sales, and hand in hand with that goes cost of sales and inventory. Okay, so don't forget that. Okay, so now the cost of sales, so that's basically half of the 2.56 million, or if you take 320 times 4,000, because in the question, I'll quickly jump back there. They tell you the cost is 320 Rand to the company. Okay, so that's 320 times 4,000. And then also only times 70%. Okay, you don't recognize the full revenue. So it's not the full cost of sales. It's only 70% of that. Then for the customer, it's a right of return asset. So that's the account that we have there. And then inventory, remember the full 4,000 is going out of our company. So we created inventory, the full 4,000 units times 320 Rand. Okay, and okay, I think, yeah, let's stop there. Okay, otherwise we're going to take too much time now. Okay, so for 2.2, they only ask you the journals at the point of sale. Okay, so not all the journals, just on that specific time that they sell. Okay, so they sell it now. There's probably 30% that will be returned. So we only recognize revenue on the 70%. You'll see in 2.3, we're going to do the rest of the journals. Okay, but I think let's stop there.
Can I email you now and you can send me this slide and the other one and I'll distribute it to Emma Santon. I can send it to the whole group.
Yes, you're welcome. I'll do
Or
that.
I'll send you an email now. Thank you.
Okay, perfect. Okay, so I think let's stop there and take the break. Let's now go till 25 to 10. Okay, so it's just more than 10 minutes. If you have questions during the break, you're more than welcome to type them in the chat. I'm just going to wait till after the break before I discuss them. Okay, so that if there is someone that just quickly step away from the computer, that they also hear the solution, okay, or my answer. So that it's not something, maybe it's something you all wonder about or something, but you're more than welcome to type it there, but I will then only answer you after the break. Okay, so we'll chat again at 25 to 10. Okay, let's continue. Okay, yo, I'm glad you received the emails because it said to me it's bigger than 6 meg, so make sure you want to send it as an attachment. So that was why I was just scared that it's not going to get to you. Okay, so let's share the screen and then we can continue again. Okay, so we stopped at 2.2. Okay, so then at 2.3, they ask you to prepare the journal entries that should be processed on the 31st of December 2023 in respect of the toys sold during October 2023. Okay, so let's just quickly refresh the memory. So they tell us that they expect a 30% return rate. Okay, so we have recognized 70% revenue, but we expect 30% to be returned. And now they tell us, back to the beginning of the October sales, that during the month they sold 4,000 units, and by 31 December, 65% of the expected returns from the toys sold in October had been processed. Now just be careful, it's not 65% of the 4,000, it's 65% of the 30% we expected. Okay, so what happened is when they sold the toys, they thought, okay, 30% of these customers will return the toys. But now they tell us that only 65% of the expected returns had been processed, meaning it's not the full 30% that actually returned the toys. So of this, let me just get there. Of this 30% that we calculated, that's 768,000, only 65% actually returned. Okay, I hope that is making sense. So now the journals we're going to do is on this 768,000, 65% of that. And then the other 35% we will then recognize as revenue because it wasn't returned. Okay, so then we can recognize that additional revenue. Okay, so your refund liability, remember we need to to cancel the refund liability now because the 60 days have lapsed. Okay, it was October sales. We are now at the end of December. At the beginning of the question, I just quickly want to show you that. They tell us there the company offers a 60-day return policy. Okay, so after the 60 days, they cannot return even if they want to. So now we cancel out the refund liability. And then this amount will be split into 65% was returned. So that's going to be credited against their accounts. So we credit trade receivables or debtors. And then the other 35% of that amount, we go take back to revenue. Okay, because they didn't return that, so we can recognize that as revenue. Okay, and then we do the same for the cost of sales. So cost of sales is the same 35% as what is taken there to revenue. Just remember the revenue will be at the selling price, cost of sales at the cost price. And now we debit inventory because remember, if they return something, the inventory is coming back to us. And then we also cancel the right of return asset. Okay, any questions there? Okay. Then 2.4, they ask you again to discuss and then with reasons how the transaction price for the contract with Kids World stores will be determined. Support your answer with appropriate calculations. Ignore the constraining or variable consideration. And then your answer should be according to IFRS 15. Okay, so very important, support your answers with calculations. So we need to do the calculations. Okay, so there you can have something like the contract with Kids World Stores includes variable amount as Tiny Treasure CC is offering a price concession. They will estimate the amount of consideration to which it will be entitled in exchange for transferring the promised goods or services to the customer. And since Tiny Treasures has a large number of contracts with customers that have similar characteristics, the expected value method would predict the amount of consideration to which it expects to be entitled. Thus, this method should be applied to estimate the amount of the variable consideration. Okay, so just to refresh your memory again, maybe. For Kids World Store, that is where they tell you that they sell this 1,000 units. And then they tell you that they sell it at 8,500 Rand, but they will give them the difference if there's other retailers that have lower prices. And then they gave us the probability of that price reduction. Okay, sorry, so that's where we are at now. Okay, so now we have to calculate, because they also tell us that you have to do the calculations, basically to state your explanation. And this is now where we look at the price reduction. So they tell us there's a 60% probability that the price will not be reduced. Okay, so that 8,500 times 60% is 5,100. A price reduction of 500 Rand. So now you will see instead of having it as 8,500, we have it as 8,000. There's a 30% probability for that. And then a price reduction of 1,000 is 7,500, and there's a 10% probability of that. So if we add everything together, the estimated price should actually be 8,250 Rand. They sold 1,000 units, so the total transaction price is then 8,250,000. Okay, and that's it for 2.4. Okay, so if you just give this explanation, and then obviously with your calculations, then that's enough. All right, then we move to question 3. Okay, there they tell us that Cocotopia Limited is a company operating in the confectionery sector. They manufacture delectable chocolates and sweets. Its fantastical factory is located in the Springfields industrial area in KwaZulu-Natal. Okay, by reading that, we don't really know where we are. So if we go to the required part, they ask you discuss how the debentures in transaction 1 should be initially recognized in the records of Cocotopia Limited in accordance with IFRS 9 and AIS 32. Okay, so now we know this is a Learning Unit 3 question. Okay, and in this question, transaction cost is included in 2 of the 3. Okay, remember this is where we have the fair value at amortized cost, fair value at other comprehensive income, and fair value through profit or loss. Okay, so it's only if it's fair value through profit and loss that transaction cost is excluded. For the other 2, it is included. Okay, so don't get confused between Learning Unit 4, calculating the fair value, and then Learning Unit 3. Okay, so let's quickly recap Learning Unit 3. Ooh. Okay, so the definition of a financial instrument, this is very important. It's any contract that gives rise to a financial asset in one entity, financial liability or equity instrument in another entity. Okay, and then we also have definitions for what is a financial asset, financial liability, or equity instrument. Okay, so please make sure that you also know that. Okay, so there's your definition of a financial asset. Yeah, so I'm not going to read through all of this again. So it's basically cash, equity instrument of another entity, and a contractual right to receive cash or another financial asset from another entity. Okay, those three are the most important ones. Then your financial liability. Okay, so it's a contractual obligation to deliver cash or another financial asset to another entity. And that obligation is to exchange the financial liability with another entity under potentially unfavorable conditions to the entity. And then lastly, your equity instrument. That's any contract that evidences a residual interest in the net assets of an entity. Okay, and then just an important question is whether that instrument is then a financial liability or equity. Okay, because remember the definition says it's an asset in the one company, but then a financial liability or equity in the other company. Okay, so the asset you know, but then you need to know whether it's a liability or an equity. And there you might have to look at what is the definition, what is the contractual obligation, and what is the substance of the contract to assist you with that. And then also remember a compound financial instrument is where there's both, where you have a liability and an equity component. Okay, so that can happen. Okay, then just the initial recognition. Yeah, this is not really something that they ask you, especially there at the bottom where you have the trade date and the settlement date. They will just tell you what is the value at initial recognition. Okay, so this is not, yeah, too important. Okay, then your measurement. And there I tell you, the classification per IFRS 9 determines how the financial instrument are measured in the financial statements. And their transaction costs are included in initial measurement for all categories except where it's fair value through profit or loss. Okay, and there's just a bit of a reminder of when it's what value, what model. So to collect contractual cash flow of principal and interest is fair value at amortized cost. To collect the contractual cash flow of capital and interest and to sell the financial asset is fair value through other comprehensive income. And then if there's a long-term or it's a selling of the financial asset or designated, then you have fair value through profit or loss. Okay, and the fair value through profit and loss, that's normally your default one. Okay, then your amortized cost. The financial asset may be classified as amortized cost if both the conditions are met. Okay, so it needs to be in a business model where the objective is to collect contractual cash flow, and the financial asset should give rise to a contractual cash flow that are solely payment of principal and interest. Okay, not selling the financial asset. Then how is that cost calculated? The amount at initial recognition less the capital repayments, add or less the amortization of discount, and then we minus the impairment loss, if there's any impairment loss. Then your financial assets are measured at fair value. The entity can then choose whether it's fair value through profit or loss or fair value through other comprehensive income. If the financial asset is designated as held for trading, it must be measured at fair value through profit or loss. Okay, and then you can just go through that held for trading, what is required. And then your financial liabilities is always measured at amortized cost, except if it's held for trading, designated at fair value, and contingent consideration. Okay, now we can look at question 3. Okay, so we had a look at the first paragraph already. So then they tell us that Cocotopia has a 30 April 2024 financial year end. During the current financial year, Cocotopia's board of chocolate dreamers resolved the following 2 transactions. Sorry. I'm first going to focus on transaction 1. So there they tell us the issue of debentures with a value of 5 million on the 1st of May 2023 to Wonka Limited. Debenture issue costs amounted to 150,000 and the contract terms are as follows. Interest is payable on the debentures, 500,000 Rand per year. It's payable in cash on 30 April every year for 5 years. Debentures will be settled in full and final settlement of 4.8 million on 30 April 2028. Okay, then the financial manager prepared the following journal entry. They tell you debit, debentures, credit, bank, and that is recognition of the interest paid as per the contract. Okay, so let's stop there for now. So at 3.1, they ask you, discuss how the debentures in transaction 1 should be initially recognized in the records of Cocotopia Limited on 1 May 2023 in accordance with IFRS 9 and AIS 32. Your discussion should include the following: the definition of a financial instrument, the definition of a financial liability, classification requirements of a financial liability, and the initial recognition requirements. Okay. So you give your definition. Financial instrument is any contract that gives rise to a financial asset in one entity, financial liability or equity instrument in another. The debentures contract gave rise to a financial liability in the books of Cocotopia Limited and a financial asset in the books of Wonka Limited. The issue of debentures therefore meets the definition of a financial instrument. And then they also ask you the financial liability definition. It's any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity, or a contract that will or may be settled in the entity's own equity instrument, is a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instrument, or a derivative that will or may be settled other than by the exchange of a fixed amount of or another financial asset for a fixed number of the entity's own equity instrument. And then Cocotopia has a contractual obligation to deliver cash in the form of capital repayment plus interest to the principal amount outstanding. And they have a financial liability in terms of IFRS 9. All financial liabilities will be classified at amortized cost, except for financial liabilities at fair value through profit or loss. And then it's designated as such or held for trading. Okay, so that's a lot. But you will see 3.1, it was 15 marks. Okay, so yeah, it is a lot. Okay. And then it also continues that Cocotopia may designate a financial liability at fair value through profit or loss when it meets the definition of held for trading, or is designated as such. Designation must take place at initial recognition and is irrecoverable. From the scenario given, debentures issued will be classified at amortized cost, as nothing indicates that debentures are held for trading or are designated at profit or loss on recognition date. The financial liabilities at amortized cost are initially recognized at fair value with transaction cost capitalized to the liability. Okay, so normally in a question like this, the memo gives about 18 to 20 marks. From that, we only give 15 marks. Okay, so if you not necessarily have all of this word by word, that's okay. Okay, remember it is, you can put it in your own words. Okay, it's only the definition that is a definition and that you cannot put in your own words. But any explanation or things in your own words, that's perfect. Okay, and then we go to 3.2, and then they tell you in bold, question 3.2 to 3.4 are based on the assumption that the issue of the debentures is classified at amortized cost. Okay, so in 3.1, we said that it's classified at amortized cost, but they give you this in case your 3.1 is wrong, because other words, everything else will also be wrong. Okay, so now they tell you we are classified at amortized cost. So 3.2, 3.3, and 3.4, we do it on that. Okay, and then they ask you to calculate the effective interest rate applicable to the issue of the debentures. Okay, because if we go back to transaction 1, they don't give you the percentage. They give you the value. They tell you what the cost amounted to the issue. They give you the interest payable. They give you how long it will be. They give you the final settlement, but they do not give you any percentage. Okay, so now at 3.2, so your future value is 4.8 million. It's for 5 years. The payment was given 500,000. And then remember, because it's fair value at amortized cost, transaction cost is part of the cost of this item. Okay, so that's why we deduct the 150,000. And then your present value is 4,850,000. And then just remember, if you put it on your calculator, if you have the present value and the future value, one of them need to be a negative figure, okay, to get your interest. Okay, so that's only 5 marks, so you can stop there. Then at 3.3, they ask you to discuss the appropriateness of the journal entry prepared by the financial manager in the books of Cocotopia Limited. If applicable, you are required to provide any correcting or additional journal entries. Okay, so remember what the accountant did is they only did the journal for the interest. Okay, which is fine, that journal is correct, but they forgot the journal where we actually issue the debentures. Okay, so we're not going to correct their journal. Their journal is fine. We're just going to add another journal. Okay, and maybe a hint for the exam is they're probably not going to ask you something if it's not there. Okay, so if they ask you, if applicable, you need to provide any correcting or additional journal, then you know there is either a correcting or an additional journal. Okay, they're not going to put it in there if it's not something that you need to do. Okay, so then the just adding to journal will then be the, wait, I just quickly want to see, they did the, oh, that's the payment. Sorry, that's the payment that they did. The 500,000, not the interest. Okay, that's the payment that they did. So we're going to do the interest. So at that 10.41 that you calculated in 3.1. And then in terms of IFRS 9, when a financial liability is measured at amortized cost, a journal entry is required to account interest using the effective interest rate method. So in addition to the financial management journal, the following also need to be processed. Okay, so it's not correcting the journal, it's just doing an additional journal. Okay, then the last one that relates to transaction 1. They ask you to calculate the carrying amount of the debentures to be recognized in the statement of financial position as at 30 April 2024. Okay, so the carrying amount on 1 May that was given to you is 4,850,000, or it was actually what we calculated. Okay, they gave you 5 million and they tell you it will cost them 150,000. Okay, and then we need to deduct the interest that we are paying, which is actually just the payment. And then we add the interest that actually accrued on this debenture. So that interest payable, that 500,000, when you actually have a loan, the first couple of years, depending on how long that loan is, you are actually paying the interest and not the capital amount of the loan. So you are basically paying off the interest, and then more or less halfway through, that's when you are actually then paying off the capital figure. Okay, that's just some interesting information. Okay, so the amount that we pay is 500,000, and the interest that they add to our account is 491,790. Okay, then we move to transaction 2. And in transaction 2, they tell us on 1 November 2022, the company acquired 6,000 shares of Leroy Limited at a price of 115 Rand each. Transaction costs amounting to 11,000 Rand were incurred relating to the acquisition. The shares are held as a long-term strategic investment. At acquisition, management irrevocably designated to recognize the fair value changes on these shares in other comprehensive income. The shares of Leroy Limited traded at 100 Rand at 117 Rand each on 30 April 2023 and 30 April 2024. Okay, just maybe something to just make sure you know of, because here and there I see there is students that sometimes struggle with that. If they give you that, like this last sentence that they give you there, the first Rand value will go with the first date. Okay, so the shares is 100 Rand on 30 April 2023 and 117 Rand on 30 April 2024. Okay, just to make sure you see that. Okay. Then they ask us at 3.5 to do the journal entries to account for transaction 2 for the financial reporting periods ending 30 April 2023 and 30 April 2024. Journal narrations are required. Okay, so very important then to remember these narrations. It's normally just half a mark, but it's an easy half a mark. Okay, so make sure you remember that. Okay, so the first one is where we then recognize the investment. And then remember, because, sorry, I just want to go back to the question for you that you can just see all the figures. So because it's recognized, it's recognized at fair value through other comprehensive income, transaction cost is part of the cost of this asset. So it's the 6,000 shares times 115 Rand, and we add the 11,000 Rand. Okay, so then we debit investment, credit bank. Apologies if you guys can hear the noise. Yeah, I don't know what the neighbors are doing, but in any case. Okay, then at that year end, they tell us that the value of the shares is now 100 Rand. So when we initially invested in these shares, it was 115 Rand. And now the value is decreasing to only 100 Rand. So we need to credit this investment. Okay, because it's not worth 701,000 anymore. And then because this is fair value measured at other comprehensive income, we use the mark to market reserve. Okay, so instead of saying fair value adjustment, we say mark to market reserve. And then we credit the investment with that amount. And then at the end of the next year, we the value is increasing again. So it was 100 Rand, and now it's increasing to 117 Rand. So now we debit the investment again, and we credit mark to market reserve. Okay, and then you'll see in a lot of these questions, they will actually tell you that they transfer the mark-to-market reserve to retained earnings. Okay, in this question, they didn't do that, so you don't have to do it. But if they ask you that, then you will basically have a look at what is this mark-to-market reserve value, what is this one. So if you set off the two against one another, the mark-to-market reserve is then a credit 1,000 Rand. So if they ask you to put this or take it to retained earnings, then you will debit mark-to-market reserve 1,000 Rand and credit retained earnings 1,000 Rand. Okay, a lot of questions do that. So if it's fair value at other comprehensive income and we use the mark-to-market reserve, they tell you in the end that the amounts that is in the mark-to-market reserve will be taken to retained earnings. Okay, so just take note of that. Okay, like I said, in this question, they didn't, so you can just stop there. Okay, any questions on question 3? Okay, then we can move to question 4. So in question 4, they tell us that Indigo Lifestyle is a leading specialty retailer of home decor, furniture, and lifestyle products. The company operates a chain of retail stores across South Africa, has a financial year end of 28 Feb. On the 29th of Feb 2024, the management team decided to dispose of parts of its assets as it wants to focus on its core products. Okay, that portion, dispose of a part of its assets, that can tell you where this is going. Or then if you look at the required part, they ask you to calculate the carrying value of the disposal group immediately before the classification as held for sale. Okay, so now we know this is a Learning Unit 5 question. Okay, so let's quickly refresh the memory. Okay, so Learning Unit 5 was non-current assets held for sale and discontinued operations. Again, there's definitions that is important. Non-current assets held for sale, disposal group, and then discontinued operations. Okay, so those 3 definitions are important. Then the classification as held for sale, very important. All this criteria must be met. Okay, so if all of that is met, then we have a Learning Unit 5. Okay, so that asset or disposal group is available for immediate sale in the present condition. The sale must be highly probable. Management must be committed to a plan of sale and an active program to find a buyer has been implemented. Asset or disposal group is actively marketed at a fair market price. Disposal is expected to be completed within 1 year of initial classification. And actions indicate that it is unlikely that the plan will be withdrawn or changed. Okay, so if they meet all those definitions or those criteria, then we can classify that as held for sale. Okay, then what is very important is that after we've classified this as held for sale, there's no depreciation. Okay, so the moment we move this from being a non-current asset, meaning let's say a vehicle or a machine, we reclassify this to a non-current asset held for sale, which then is actually a current asset, depreciation stops. Okay, same for amortization. If it's an intangible asset that we move to held for sale, amortization will stop. Okay, so that's very important to remember. And then that non-current asset or disposal group must be remeasured to the fair value less cost to sell at year end. And then the tax implications is that SARS doesn't classify these assets as held for sale. So in other words, they will keep on depreciating for that full year and not stop when it's moved to an asset held for sale. So what they did in, I think in the 2023 and 2022 papers, especially 2022, I know, they also combined Learning Unit 1 and Learning Unit 5, okay, because there is where the tax is coming in. So you had to do Learning Unit 5, and then from there, they give you information that you were able to do Learning Unit 1 as well. Okay, so be careful of that. It can be combined. Okay, then the disclosure of a non-current asset or disposal group as held for sale. It's classified as held for sale, be disclosed separately from other assets in the statement of financial position, and your assets and liabilities should not be offset against one another. And then the major clauses should be separately disclosed. Okay, and then the discontinued operations. What is a discontinued operation? Just a reminder of the definition. Okay, and then we can look at question 4. Okay, so question 4, they tell us that Indigo Lifestyle Limited is a leading specialty retailer of home decor, furniture and lifestyle products. The company operates a chain of retail stores across South Africa and has a financial year end of 28 Feb. On the 29th of February 2024, the management team decided to dispose of part of its assets as it wants to focus on its core products. The disposal group identified will generally form part of the manufacturing segment. It is anticipated that the actual sale of the assets and settlement of liabilities will take place in May 2024. The disposal group, which meets the criteria to be classified as held for sale, so there they tell you, it meets all the criteria, so now you know, okay, you are in Learning Unit 5. It comprises the following disposal group. So there they tell you what this group is. There's land, there's a commercial building, there's vehicles, there's investment property, there's inventories. Then the additional information, there's a balance on trade creditors that form part of the disposal group, and that was 2,450,000. And on 29 Feb 2024, the fair value of the disposal group was 7.5 million. And they tell you the following costs were associated with selling the disposal group: commission on sale and capital gains tax. Just remember that capital gains tax is specifically excluded from these costs. Okay, that's in your theory. Okay, then they ask you at number 1 to calculate the carrying value of the disposal group immediately before the classification as held for sale. Okay, so let's look at that one. Okay, so very important, on 29th of February, that's when the team decided to dispose of part of these assets. So now what's going to happen is, if we didn't do depreciation yet for the year, that depreciation needs to be calculated up to the 29th of Feb 2024. Okay, you'll see for this question, it was full years. So the depreciation was for a full year. But just remember that it can happen that it's only for, let's say, half the year. Okay, so they only go to, let's say your year runs from January to December, then they will tell you on 30 June they decided to sell. Okay, so then you need to depreciate for only half the year. Okay, but in this case, it was a full year, so we depreciate for a full year. Sorry, I just want to jump back. Okay, so land, they give you the cost, but just be careful before you jump in and use cost, because land doesn't depreciate. Remember, land can be impaired. So that's what happened. So we need the carrying amount. So for land, we use that carrying amount. And even though the carrying amount that they give you is the previous year, they didn't tell us that in this year there was another impairment or anything. So then we can use that value. Okay, so for land, we use the carrying value. But then remember, anything else, if the carrying amount is the previous year, you need to do depreciation for this year. Okay, they tell us Okay, so the next one we have is the commercial building. There's depreciation for 2023. There was impairment, so there's the carrying amount. But this carrying amount is 2023. Okay, we need 29 Feb 2024. Then they tell us there that the building is depreciated using the reducing balance method at 8% per year. The residual value is insignificant. Okay, so now for building, we can then calculate the depreciation. That depreciation we deduct from the carrying amount given, and then we have the carrying value for this year. Okay, then the next one we have is vehicles. So they tell us the branch has several vehicles that are used by the employees as company vehicles, which is part of their remuneration package. The vehicles are accounted for in accordance with the cost model and are depreciated on the straight line basis over the estimated useful life of 5 years. The residual values of these vehicles are insignificant. No vehicles were purchased or sold during the 2024 financial year. Okay, so then also they give you the cost, they give you the accumulated depreciation, they give you the carrying amount. Again, remember that carrying amount is the previous year. So we still need to depreciate these vehicles for this current year that we are in. So on the cost, 820,000 divided by 5, because they tell us the estimated useful life is 5 years. We deduct that from the carrying amount, and then we get the new carrying amount for vehicles. Okay, then next we have investment property. And remember there, the investment property is always carried at your fair value less cost to sell. Sorry, it's carried at your fair value. Sorry, your investment property is carried at fair value. They give you the cost to sell. That's what I wanted to say. So since 1 March 2018, the branch has had an old showroom that has been leased out in terms of an operating lease. The investment property is accounted for in accordance with the fair value model. And then they give you the following information relates to the investment property. And you'll see there's 2 fair values. Just be careful, we use the one on the 2024th. Okay, because that's when they decided to sell. So we need the carrying amounts for the group on 29 Feb 2024. But of that carrying amount, investments is always carried at fair value. Okay, so then that fair value is 3.8 million. So you'll see, even though they give you the cost to sell, we ignore that. Okay, then for inventory, they tell you it comprises various lifestyle products that are available for sale. Inventories are measured at the lowest of cost and net realizable value. Okay, remember that's the rule. It's not necessarily that they will tell you that in the question. Okay, they don't have to. You need to know that inventories is measured at the lower of cost and net realizable value. It's written down to the net realizable value as a group. And then they give you the information. There's cost and there's net realizable value. Remember, it's the lower of the two. So that's why your inventories will be 3,670,000. Then lastly, we have our trade creditors. That's part of additional information. And that value is just what they give you. Okay, remember, if you owe someone money and you decide, okay, no, well, I'm going to sell my shop, you still owe them the money. Nothing is going to change that. Okay, obviously, unless they give you a discount or something like that. But for your purposes, that will probably not happen. So trade creditors is the amount that's given. Okay. And then remember, that's a liability. So we deduct that from the total. And then if you start at land, you add the building, add the vehicles, add investment, add inventory, minus your trade creditors, you get your total carrying value on the date of, well, when they decided to sell. Okay, it is before the actual sale, but that was the date that they decided to sell. Okay, any questions up to that point? Okay, I think then we can stop here for a break again, and then we'll continue with that question. So I think you have survived 2 hours. So let's take a 15-minute break. So let's say 25 to 11. Then we'll start again. Okay, so just again, if you have questions, you're more than welcome to ask that. If you want to, you can type it there in the chat as well. And then, as I mentioned earlier on as well, after the break, I will then discuss the questions. Okay, so that you can just all hear my answer. But yeah, you can take your break and then we'll continue at 25 to 11. Okay, let's continue with the last part of the session. So I'm just going to share my screen again. Okay, so just before the break, we had a look at 4.1, where we then calculated the carrying value of the group immediately before classification as a held for sale. Now they ask you to prepare the journal entry in the financial statements of Indigo Lifestyle Limited to allocate the impairment loss or reversal of the impairment loss to the individual items in the disposal group after classification as held for sale. Show your calculations. Your answer should be in accordance with IFRS 5, and journal narrations are not required. Okay, so what the calculations entails is that you first now have to calculate whether there is an impairment loss or not. And remember, to do that, we use the amount that we calculated in 4.1 and compare that with the fair value less cost to sell of the group. And that was given to us. There at the bottom of this slide, you will see they tell you on the 29th of Feb 2024, fair value on this group was 7.5 million, and then they give you the cost. Okay, and then from that, we can see whether we have an impairment loss, yes or no. Okay, so let's look at the calculation. So the fair value they give you is 7.5 million. And then the commission on sale is cost that we need to deduct. Remember, the capital gains tax we will not deduct because it's specifically excluded per the definition of cost to sell. So then the value that we get is 7,225,000. The carrying amount we calculated at 4.1 was 7.8 million. Okay, so this needs to be carried at the lower of the two. So in that case, the lower of the two is the fair value less cost to sell. And then we do have an impairment loss. Okay, and that's the difference between the carrying amount, the 7.8 million, and the fair value less cost to sell, which is 7.2 million. And then we need to allocate that impairment loss. Now, just remember, when we allocate the impairment loss, not all your assets will qualify. Just want to jump back to 4.1. Okay, so not all the assets or everything in that group will qualify. Okay, so what will qualify is your PPE and intangible assets. Okay, so in this case, it will be land, building, and vehicles. Okay, that's the only thing that will be impaired. The reason for that is investment property is carried at fair value. That's the rule. Okay, so that is the value it needs to be carried at. Inventory is the lower of cost or the net realizable value. Again, that's the rule. It's not going to be impaired. That's the value it should be carried at. And then trade creditors, as we said earlier on, if you owe someone money, that's the amount that you owe them. You can do nothing about that. Okay, so in this case, that impairment loss will only be allocated to land, buildings, and vehicles. Okay, so make yourself a note, PPE and intangible assets. That's the two things that will then qualify for the allocation. Okay, so you'll see at the top, I have the three, and then we've calculated only these three's carrying amount, because now we need to calculate what percentage is land of the total. And that same percentage is the portion that land will get from the impairment loss. Okay, so you can see I did include the calculation there. So land divided by the total, and then actually times 100 times your impairment loss. We do the same for buildings. It's the value for buildings divided by the total times your impairment loss. And then vehicles is the value of vehicles divided by the total times your impairment loss. And then you have, oh, sorry, the decrease of each of these assets. Okay, now we can actually get to the journal. Okay, because they ask you to do the journal for impairment loss or the reversal of the impairment loss. So we debit impairment loss with the total value. And then we credit each PPE item that gets a portion of that loss. So it was land, building, and vehicles. Oh, sorry for that. Just when I think I'm over it, then it hits me again. Okay, then 4.3, they ask you to do the disposal group disclosure note in the financial statements. Oh, sorry. Okay, then there's always, I call it a little story that you have to write, and that you can just get from the question. Okay, so in the question, they tell you the date when they decided to sell, when they expect this group to be sold. Okay, all of that. So it's a bit of a copy and paste of the story that they tell you. So something like a decision to dispose of a group of assets and related liabilities was taken late in February 2024 with the objective of focusing on core products of the company to a larger extent. It is expected that the assets under this disposal group will be sold for cash and that the disposal will be completed by the end of May 2024. Okay, so you give dates and information that they give you in the question. Okay, and then also very important is to just give the amounts. And these amounts is then after the impairment have taken place already. Okay, so you'll see land. It's the same value that we used in 4.1, but then minus the portion of impairment loss that land is getting. Oh, sorry. The same for buildings, the same for vehicles. Okay, then your investment property is exactly the same value as we had in 4.1, because remember, investment property is carried at fair value. Inventories is also exactly the same as what we had in 4.1. The lower of cost and the net realizable value. And then lastly, your trade creditors, again, that's the amount that we owe them. Okay, we're not going to change that to any other value. Okay, and then the last bit of story is where there is an impairment loss to give the amount. So in total impairment loss of 629,960 was recognized on initial classification of the disposal group as held for sale. This amount was included under other expenses on the face of the statement of profit or loss and other comprehensive income. And the disposal group forms part of the manufacturing segment. Okay, so all of this will then be your disclosure note for this group. Okay, then we finally get to question. Okay, so that's question 5. So you'll see there they start us with Essentia Limited is an exciting new manufacturing in the fragrance industry based in the coastal city of East London, South Africa. Then they give you the accounting profit before tax for the year ended 31 March 2024. Okay, so in your brain, you should now sort of start to wonder, why do they give us the profit before tax? Probably because this is then a learning unit 1 question. Okay, so always just confirming the required part. So if you go down, they ask you to prepare the income tax expense disclosure note. Okay, so now we know, okay, this is learning unit 1. Okay, so just quickly refresh on learning unit 1. So learning unit 1 was income taxes. And you will see, even though question test 1, the whole question was learning unit 1, learning unit 1 is still quite a big portion in the exam. Okay, so sometimes bigger than other times, but it has been before that learning unit 1 is still 60 marks. Okay, so for you, it will probably be a bit less because remember prior to last year, the exam were 180 marks. Okay, so then a third of the paper was still on income taxes. Okay, so it's still a very important learning unit. Also going into semester 2, we will refer back to learning unit 1. Okay, so please don't forget this learning unit. Okay, so we said what income tax is made up of. And this is very important because you'll remember now, if you think about the question, they ask you to do the income tax note. So income tax is current tax, over and under provision, deferred tax. Okay, and it will also actually include your rate change, if any. Okay, so just remember that income tax is not equal to tax. Current tax and your over and under provision and your deferred tax is your income tax. Okay, then just again to remember where this is sitting on your statement. So learning year 1 and 2, first year and second year accounting, you just took the profit before tax, times it with 27%, you had your income tax. But now you've seen that that's not actually 100% correct. Okay, so we are changing this income tax expense in learning unit 1. Okay, so just again, what is current tax? It's an estimate of the entity's tax liability for the current period, calculated according to the existing tax legislation. And then your journal is debit income tax expense, credit your income tax liability. Okay, so remember, this is if we have to pay taxes. Okay, so if we make a profit, that's your journal. Okay, then just again on the over and under provision. So when you have a company, they are registered for provisional taxes. So what you do is after about 6 months of the year, you calculate what you think your profit will be for a full year. So you take your information for 6 months, we times it by 2, and we say, okay, this is what we think the profit will be. And on that, we pay what they call provisional taxes. But that's obviously not going to be 100% correct because we didn't have the correct actual figures. And that is then where an over and under provision is coming in. So if the amount settled with SARS differs from the amount recognized as a liability in the previous year, an over or under provision will arise. Okay, so if we have an over provision, the amount is settled smaller than the amount previously recognized. And then an under provision, the amount settled is bigger than the amount previously recognized. Okay, then just a bit on your deferred tax. Remember, that is an accounting entry that arises on differences between the carrying amount of the asset and liabilities in the statement of financial position as per the IFRS and their tax base as per tax legislation. Okay, so remember, carrying amount is what we do in company books. Okay, we depreciate vehicles at 20%, for instance. Tax base is what SARS allows. So according to law, let's say vehicles should be depreciated at 25%. Okay, so tax base is then what SARS allows. Oh, sorry. And then a deferred tax arises because your accounting profit is not equal to taxable income. Okay, and then we have the differences. Remember, we have exempt differences. There's no tax consequence. And then we have temporary differences, and that's the difference between the carrying amount and the tax base of an item in the statement of financial position. And your deferred tax is only calculated on temporary differences. And then your deferred tax movement, that is just the opening balance and the closing balance compared. Okay, that is your movement. And then remember, if there is a rate adjustment, then your deferred tax balance at the beginning of the year is restated to the new rate before the current year deferred tax movement is then calculated. And then you can just relook at example 8.23. Okay, the presentation I'm not really going to look at again. I'm sure you know that by now. And then I just made you a bit of a summary that you have to understand this learning unit, not study it off by heart. There's just too much going on. And then the tax base of an asset represents the portion of the carrying amount that the entity may deduct in future for tax purposes. Future tax consequences are dependent on how the asset will be recovered and the liability will be settled. And remember, assets can be recovered through use, sale, or both. And after you've determined the tax base, you can calculate the deferred tax liability or deferred tax asset. And the deferred tax is also not just a mathematical calculation. Okay, and then we can look at question 5. Okay, so we had a look at up to that accounting profit before tax. And then they tell us included in the accounting profit before tax amount was dividend income, penalty for the late submission of VAT. Okay, very important. Remember, that should be included in your profit before tax. Okay, because your profit before tax includes all your income, all your expenses. Okay, so it happened previous years that they tell you excluded in the accounting profit is dividend income and a penalty. Please don't just then leave it and think, well, okay, now I just don't have to do my exempt, the part that is exempt. Because you then need to fix your profit before tax. So in other words, bring in the dividend, bring in the penalty, and then you start your tax calculation. Okay, so make very sure whether all the costs that should be included are included. Okay, and then they give you the following assets that were included in the trial balance. There's plant, machinery, prepaid expenses, research and development. And then they give you a note. So they tell you a little bit about everyone. What was plant acquired for? How is depreciation calculated? The remaining useful life of the machine is 6 years. When it was acquired, it's depreciated on the straight line method. Then the prepaid expense was an annual insurance premium that was paid on the 31st of January 2024. And then what they spend on research and development, and it's company policy to capitalize research and development cost. This asset is not amortized. Okay, then they tell you that SARS grants an allowance of 20% per annum on all plant and machinery. Then Section 23H of the Income Tax Act will only allow the deduction of a prepaid amount if the prepaid amount relates to goods or services that ought to be rendered within 6 months after year end, or where the total of all the prepaid expenses does not exceed 100,000 Rand. SARS allows 150% deduction on research and development. In the budget speech, the Minister of Finance announced that the tax rate will be lowered from 28 to 27. Okay, so there we have a change in the tax rate. The company accounted for the remeasurement effect on the deferred tax account balance by adjusting the opening balance. Then on the 31st of March 2023, the credit balance on the deferred tax account was 55,440, assume correct. There's no temporary difference on the 31st of March 2024 other than those arising from the information provided. Okay, and then we have this huge question, and it's 35 marks. So they ask you to do the income tax expense disclosure note. Okay, so obviously for 35 marks, there's going to be a lot of calculations involved as well. Okay, so we already said income tax is current tax, over or under provision, deferred tax, and then the rate change, if any. Okay, so please don't just fall away with your note, because if you calculate something just on your calculator, you don't write down anything and it's wrong, you get no marks. If you at least give us as markers a calculation, then we can get you as many marks as possible. Even though your amount might be wrong, there's portions of your calculations that we can still give you marks for. Okay, so please, for 35 marks, don't just do the note and think, I'll somewhat do the calculations on my calculator and then just put in the amount. Okay, so we're first going to calculate current tax. So profit before tax were given to us in the question, and then they tell you there's dividends and there's a VAT penalty. Okay, so that's your exempt differences. They also give you the amount for research and development. They tell you it was capitalized, and then they also tell you that SARS allow 150% on that. Okay, then we move to temporary differences. Remember, now you need to calculate the depreciations. Okay, so if we jump back to the question, they in the notes, they tell you plant is depreciated at 10% per annum. They tell you machinery has a remaining useful life of 6 years. And then at the additional information, they tell us that SARS grants an allowance of 20% per annum on all plant and machinery. Okay, so that's your wear and tear. So your depreciation on plant is then 1.5 million times 10%. And remember, depreciation is added back. Then wear and tear is what SARS allows. They allow a 20% deduction. Then your depreciation on machinery, the remaining useful life is 6 years. So we add that back, and then SARS allow a 20% deduction. Okay, then we can calculate our taxable income, and then on that, current tax of 27%. Okay, so now we did the current tax. We also have to look at the deferred tax. Oh, sorry about that. Okay, so there's your plant, carrying amount, tax base. And then remember, the difference between the carrying amount and the tax base is your temporary difference. And on that difference, we calculate the tax. Okay, and then the catch on this one was prepaid expenses. Normally, for prepaid expenses, we put it to carrying amount. Then your tax base is 0, and then your difference is 125,000, or actually lower than that. In this question, they tell you, let me just quickly get that. Where did they tell us that? There. So the second bullet, section 23H, will only allow the deduction of a prepaid amount if the prepaid amount relates to goods or services that are to be rendered within 6 months. And then they tell us, or where the total of all prepaid expenses does not exceed 100,000 Rand. In this case, it does exceed 100,000 Rand. Okay, your prepaid expense was 125,000. And that's why there's then no tax on that. Okay, so then your carrying amount is 125. That's also the tax base. And then that's the difference is 0, and there's no tax on that. Okay, then we also have to look at the change in the tax rate. You can actually, first do the working, and then we're going to go to the movement. So they give you the opening balance is 55,440. They give you that in the question, and then in brackets, they tell you assume this is correct. And then we times that by how much the percentage is changing. Okay, so it's changing from 28 to 27. So that's only 1%. And then divided by the old tax rate. Okay, so it's moving from 28 to 27. So 28 is then the old tax rate. And now we can look at the movement in deferred tax. And I always tell the students, your signs can be different. Sometimes maybe you put the opening and closing as a negative because they are both a liability. Whatever works for you. Okay, doesn't matter. As long as in the end you get to a movement of 53,460. Okay, so if your signs are different, maybe you put everything as a negative because it's a liability, but you know in your head you need the difference between the two because it's just moving from 55 to 106. Okay, whatever works for you, that's fine. Okay, now finally we can actually get to the note that they asked us. So remember, this note is current tax, deferred tax, and the change in the tax rate. In this question, we didn't have any over the provision. And this is just copy and paste the amounts that you got. Okay, and remember, this is very important. If you copy the current tax amount that you have, this will probably be a method mark in the exam. So if this amount, even though it might be wrong, if we can see how you got to this amount and you use the wrong amount correctly, we can still give you this mark. Okay, so don't go and just think, I think I'm wrong, I'm somehow going to use another amount. Okay, because if we can't see where it's coming from, you can't get that method mark. Same for the deferred tax, same for the change in the tax rate. Okay, and then also remember your tax rate reconciliation, and that is only on your exempt differences, and we only use the tax portion. Okay, so we start with the net profit before tax. That was 2,170,000. Tax on that 27%. Then your dividends received, again, it's the tax on that. VAT penalty, the tax of that. Research and development, the tax portion of that. Then also just remember to include your rate change. And then you will see that these two figures that I've put in bold should then be equal. Okay, if it is equal, then you know, perfect, no mistakes. Okay, all of that was then 35 marks for that question. Okay, any questions on question 5? Okay, this is all from my side for today. So I think for the remainder of the session, we have another 20-25 minutes left. I will then discuss questions. So if you have any questions on any learning units, you're more than welcome to ask that. If you don't have anything and you want to leave the meeting, you're more than welcome to do so. So the recording will be uploaded onto YouTube. The slides and things will be shared with you as well. If you don't get the slides for whatever reason, or you are in a hurry, you want it now, you're welcome to send me an email and then I can just send you the slides. But yeah, good luck with all the studies. Enjoy your weekend, and then we'll probably speak again next semester. Good luck with all the studies.